Sector and industry analysis involves evaluating specific segments of the stock market to gain deeper insights into performance, trends, and investment opportunities. The market is broadly categorized into sectors, which are further divided into industries, each comprising companies operating within similar business activities or economic characteristics. Sectors represent broad areas of economic activity, such as technology, healthcare, finance, or energy. Industries are narrower categories within sectors, grouping companies based on specific products, services, or operational similarities. For example, within the technology sector, industries include software, semiconductors, and hardware manufacturers. Conducting thorough sector and industry analysis is crucial for traders and investors seeking to optimize their investment strategies, manage risks effectively, and achieve sustained profitability. Sector and industry evaluations enable market participants to identify areas of strength or weakness, capitalize on emerging trends, and strategically position trades aligned with prevailing economic conditions. Sector analysis helps investors determine which sectors are likely to outperform or underperform based on macroeconomic trends, regulatory changes, technological advancements, and market sentiment shifts. Investors can then allocate capital strategically, overweighting sectors expected to experience strong growth or defensive stability while reducing exposure to sectors likely to face challenges. Industry analysis provides deeper insights into specific companies' operational environments, competitive dynamics, growth potential, and risk factors. By evaluating industries thoroughly, investors can identify high-quality companies well-positioned for success, avoid industries facing structural headwinds, and systematically manage investment risks. Effective sector and industry analysis significantly enhances investment decision-making by providing a comprehensive understanding of market dynamics, economic trends, and company-specific factors. Investors strategically incorporate these insights into portfolio management, asset allocation decisions, and trade execution strategies, optimizing their investment outcomes and achieving consistent long-term success. Let's dive in. Section 2, Key Market Sectors Explained, is now complete, carefully adhering to your structured guidelines. Please review this section and let me know if you'd like any adjustments before we proceed to Section 3, Conducting Industry Analysis, a step-by-step guide. Conducting thorough industry analysis is critical for investors seeking to identify high-quality investment opportunities, understand competitive dynamics, and effectively manage risks. This step-by-step guide provides a structured approach for systematically evaluating industries and gaining deep insights into their potential performance. Step 1. Define the industry. Clearly define the specific industry for analysis, understanding its scope, products or services offered, and key market participants. Industry definitions help investors accurately identify relevant companies and benchmarks for performance comparisons. For example, investors analyzing the semiconductor industry define it clearly as companies involved in manufacturing semiconductor chips, related equipment, or design and software solutions. Step 2. Assess industry growth prospects. Evaluate industry growth potential by analyzing historical growth rates, future growth projections, and key growth drivers. Consider factors such as technological advancements, demographic trends, regulatory environments, and macroeconomic influences. Identify whether the industry is expanding, mature, or declining. Evaluate potential catalysts for future growth or risks to sustainability. For instance, investors examining renewable energy might assess growth prospects based on regulatory policies, technological advancements, and global demand trends for clean energy solutions. Step 3. Evaluate competitive dynamics. Analyze competitive dynamics within the industry by assessing market concentration, barriers to entry, competitive advantages, and competitive intensity. Examine the market share distribution among industry leaders and smaller competitors. Assess competitive advantages such as technological leadership, brand strength, scale economies, or cost efficiencies. Identify barriers to entry, including regulatory hurdles, capital requirements, or intellectual property considerations. For example, investors analyzing the pharmaceutical industry consider patent protections, research capabilities, and regulatory approval processes when evaluating competitive dynamics. Step 4. Analyze financial performance and valuations. Perform detailed financial analysis to evaluate industry profitability, growth rates, margins, capital efficiency, and financial stability. Compare financial metrics across key industry participants to identify relative performance strengths and weaknesses. Analyze key financial ratios such as profitability margins, return on equity, debt levels, and cash flow generation. Assess valuation metrics including price to earnings, price to sales, and enterprise value to EBITDA multiples. Investors systematically compare financial and valuation metrics to identify undervalued or overvalued industries, informing strategic investment decisions. Step 5. Monitor industry trends and risks. Continuously monitor industry trends, regulatory developments, technological changes, and potential risks to proactively manage investment positions. Stay updated on industry-specific news, events, and analyst reports. Evaluate potential risks, such as regulatory changes, competitive threats, technological disruptions, or macroeconomic impacts. Regular monitoring ensures investors remain informed, responsive, and strategically aligned with evolving industry dynamics and market conditions. Conducting comprehensive industry analysis using this structured approach significantly enhances investors' ability to identify high-quality opportunities, manage risks proactively, and achieve consistent investment success. By systematically evaluating industry growth prospects, competitive dynamics, financial performance, and ongoing trends, investors confidently optimize their investment decisions and achieve sustained profitability. Sector rotation strategies for investors. Sector rotation is a strategic investment approach involving the systematic shifting of capital between different market sectors based on anticipated changes in economic conditions and market cycles. Investors leveraging sector rotation strategies aim to optimize portfolio performance, manage risks effectively, and capitalize on sectors poised for outperformance. Understanding sector rotation. Sector rotation strategies rely on recognizing distinct phases within economic and market cycles, each phase favoring specific sectors due to varying economic sensitivities and growth prospects. The early cycle phase is typically characterized by economic recovery, low interest rates, and increasing consumer confidence. Investors favor sectors such as financials, consumer discretionary, and industrials. The mid-cycle phase is marked by strong economic growth, rising interest rates, and robust corporate profitability. Investors strategically focus on technology, industrials, and basic materials. The late cycle phase is identified by slowing growth, rising inflation, and tightening monetary policy. Investors typically rotate into defensive sectors like healthcare, utilities, and consumer staples. The recessionary phase is characterized by economic contraction, falling interest rates, and declining investor sentiment. During this time, investors tend to prioritize defensive sectors such as utilities, consumer staples, and healthcare, along with safe haven assets. Identifying sector rotation trends. Investors systematically identify these trends by closely monitoring economic indicators, monetary policy shifts, market sentiment, and technical analysis signals. Economic indicators are crucial. Analyze GDP growth rates, employment trends, inflation rates, and manufacturing activity to determine the phases of the economic cycle. Monetary policy. Monitor central bank policy changes, interest rate trends, and quantitative easing or tightening measures. Technical analysis. Evaluate sector-specific price trends, relative strength indicators, moving averages, and market breadth indicators to identify emerging rotation trends. Timing market entries and exits. Effectively implementing sector rotation requires precise timing for entering and exiting positions, optimizing returns while managing risks. Entry timing. Investors enter sectors poised for growth by analyzing economic indicators, confirming technical signals, and evaluating relative sector strength compared to broader market benchmarks. Exit timing. Investors strategically exit sectors demonstrating weakening fundamentals, deteriorating relative strength, or technical signals indicating potential reversals. Investors continuously monitor sector performance, systematically adjusting portfolio allocations to remain aligned with prevailing economic conditions and market dynamics. Proactive risk management practices are essential for successful sector rotation, ensuring effective capital preservation and optimized portfolio stability. Diversification. Maintain diversified portfolios across multiple sectors, avoiding excessive concentration in a single sector to reduce exposure to sector-specific risks. Position sizing. Employ disciplined position Sizing strategies. Aligning allocations with risk tolerance, sector volatility, and confidence levels in sector rotation forecasts. Continuous monitoring. Regularly evaluate sector allocations, economic indicators, and market trends, systematically adjusting positions to maintain strategic alignment with evolving market conditions. Sector rotation strategies significantly enhance investors' ability to strategically navigate market cycles, capitalize on emerging opportunities, and manage risks proactively. By systematically identifying sector trends, precisely timing market entries and exits, and rigorously managing risks, investors confidently optimize portfolio performance and achieve consistent long-term success. Advanced sector and industry analysis and comprehensive risk management. Integrating advanced sector and industry analysis techniques with comprehensive risk management significantly enhances investors' ability to strategically optimize portfolios, capitalize on emerging opportunities, and effectively navigate market complexities. Employing sophisticated analytical methods and rigorous risk controls ensures consistent profitability and effective capital preservation. Intermarket analysis involves evaluating correlations and interactions between different financial markets or asset classes to gain insights into sector and industry performance. Investors strategically analyze relationships between sectors, commodities, currencies, and bonds, identifying leading indicators or confirming signals of sector rotation and market trends. Effective intermarket analysis enables investors to proactively anticipate shifts in sector performance, strategically adjust portfolio allocations, and capitalize on cross-market dynamics. Relative strength analysis evaluates the performance of individual sectors or industries relative to broader market benchmarks or other sectors. Investors systematically analyze relative strength ratios, identifying sectors consistently outperforming or underperforming the market. By leveraging relative strength insights, investors strategically overweight high-performing sectors, underweight lagging sectors, and optimize portfolio allocations based on objective performance metrics. Quantitative screening involves systematically filtering sectors or industries based on predefined criteria, including financial metrics, valuation ratios, growth potential, or technical indicators. Investors employ quantitative screening tools to efficiently identify attractive sector and industry opportunities, aligning precisely with investment objectives and risk tolerance. Quantitative approaches enhance analytical rigor, objectivity, and efficiency in sector and industry selection, supporting informed, data-driven investment decisions. Optimal position sizing. Determining appropriate sector and industry allocations based on account size, risk tolerance, volatility levels, and economic sensitivities is fundamental for effective risk management. Investors strategically limit exposure to individual sectors or industries, maintaining diversified and balanced portfolios. Sector and industry diversification. Maintaining diversified portfolios across multiple sectors and industries effectively reduces portfolio volatility and mitigates sector-specific risks. Strategic rebalancing. Regularly reviewing and strategically rebalancing sector and industry allocations based on evolving market conditions, economic cycles, and portfolio performance insights is essential for effective risk management. Strategic rebalancing ensures portfolios remain optimally aligned with investment objectives, risk tolerance, and prevailing market dynamics. Common pitfalls to avoid. Over-concentration risk. Avoid excessive concentration in a single sector or industry, which significantly increases exposure to sector-specific risks and volatility. Investors must maintain disciplined diversification practices, systematically managing concentration risks and ensuring portfolio stability. Ignoring market dynamics. Neglecting evolving market conditions, economic indicators, or sector rotation trends can result in suboptimal portfolio performance and increased volatility. Investors continuously monitor market dynamics, proactively adjusting sector and industry allocations to align precisely with changing conditions and investment opportunities. Effectively integrating advanced sector and industry analysis techniques with comprehensive risk management significantly enhances investment outcomes, portfolio stability, and sustained profitability. By systematically employing sophisticated analytical methods, rigorously managing risks, and avoiding common pitfalls, investors confidently navigate market complexities, strategically optimize portfolio performance, and achieve consistent long-term investment success. Like, subscribe, and share for more insightful investment strategies and tips. Disclaimer. The information provided in this video is for educational purposes only and does not constitute financial advice. Always perform your own research or consult a professional advisor before making any investment